Sovereign debt with negative yields does not mean confidence in governments or their policies at all. When we see European governments that have increasing solvency issues, rising deficits, and significant growth and jobs problems, financing themselves at negative rates, that is not because investors are very confident about the Eurozone or about the prospects of growth of these countries. It is because the European Central Bank is disguising and accumulating risk. This is not eternal, it is not devoid of risk, and it certainly doesn't show confidence in governments. In fact, it works as an incentive to perpetuate imbalances because governments are not implementing structural reforms and using monetary policy as an excuse to avoid those structural reforms. Think about this. Even governments in Slovenia, Slovakia, Lithuania, Portugal, Greece, Spain, governments that are financing themselves at negative rates are avoiding structural reforms, and at the same time what we see is that even a very small increase in rates, something like 20-30 basis points, would create massive negative implications on budgets and on the economy. It also leads investors to believe that there is lower risk than there actually is. And it's not eternal, because the European Central Bank cannot just continue to finance these deficits eternally. One, because it's not the world reserve currency. Two, because its entire confidence depends on the ability of these countries to recover and to grow faster. And third, because the Eurozone trade surplus that keeps the euro relatively strong is not eternal either. So we need to be extremely concerned about those that are defending massive deficit financing from central banks, because it disguises risk, but it does not eliminate it.